Okay, let's begin. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh, and greetings to everyone. A very good morning. Today we are going to cover another topic. Last week we covered cost of capital. This week we are going into financial leverage. It is all related, and actually we have touched it earlier, but we want to strengthen the discussion by looking at the leverage is the American term, and the English term is gearing, gearing, financial gearing. And the principle is that we are, I think in physics, we learn that when we use gear, we will be able to perform tasks that is heavy, and the lever is making it lighter. And the principle is also used in the engine. A car will have 5, 6, 7 gears nowadays. At least 3 gears if you are on auto. And the gear helps to reduce the load because the gear has the ability to reduce the power needed to cool. So when we engage into the first gear, it is just to move the vehicle, so it can move forward, but we cannot go on with the first gear forever because the first gear is heavy. It's heavy. It is just to move. We need to quickly change to the second gear that will push us forward, and then move again to the third gear. As we go into the higher gear, we will be able to move faster at the lower load. So leverage or gearing will help us reduce the power needed to accelerate. But actually, there is a disadvantage of this gearing system, because if we suddenly need to reduce speed or stop, we need to quickly press the clutch. Otherwise, the engine will jerk and brake. That is because the higher gear is not able to cover a lower speed. And this is the same thing with finance. In finance, we need to start with the lower gear to start with, and the gear must be suited with the size of the business and the speed of the transaction that we make. As we grow bigger and the speed of the transaction get faster, we need to engage into higher gear, and that's when we need financing. So gearing is about financing, and financing is about taking a loan or borrowing. As we discussed earlier, that in the conventional finance, borrowing is uh, is the best strategy in business because a loan or borrowed money is the best form of capital. Why it is the best form of capital is because the borrowing cost is always much lower than the expectation of the owner that provide the capital. So if we use our own capital, the expectation in the form of return will be much higher. For example, as an investor, you may want to at least make 15% per annum. That is your target. But if you borrow from the bank is only asking 6% or 8% per annum. So you have that margin, the 8 or 9% as the difference between your expected return and the bank expected return. Right. So we say that the borrowed money is the best form of capital, and hence we must try to maximize borrowing. But at the same time, we must be careful that the borrowing must be uh, in proportion to the size of business, because if the borrowing is too high in relation to the size of business, then we, like a car, we engage into fifth gear when we are only traveling at 20 miles per hour, then the car will jerk and soon it will go dead. So we need to be exercising a good discretion in determining what is the right leverage of
Okay.
then all right. Okay, so now we will look at how we will calculate gearing and how do we know whether our gearing is suitable. By the way, in Islamic finance, there is no such thing as leverage or gearing, because in Islam there is no principle of borrowing to conduct business. If you want to conduct business in Islam, you can only use equity financing. What is equity financing? Is to use capital. The problem is, how can you expect a person who do not have anything, who's just starting a business, raise capital? And the answer is the principle of mudarabah, for example. Mudarabah in Islamic finance is a very unique kind of partnership between the capital owner and the entrepreneur. So, for example, if you are the entrepreneur in Islam, we call you as mudarib. The word mudarabah come from the word mudarib, means you are the entrepreneur, the pengusaha. So you will find, as an entrepreneur, you will prepare a project proposal plan, and you will commit yourself to run the business, and you find a capital owner or capitalist. And a capitalist in Islam is called the sahibul mal. So the sahibul mal means the capital owner. So the sahibul mal will then partner with you, form a partnership called the Mudarabah partnership, where he, as the capital owner, will contribute 100% of the capital, and you as the entrepreneur will contribute 100% of the entrepreneurship or effort. So you will be running the business, and the capital owner will be providing the capital. And then there will be a partnership agreement where, as a mudarib, as an entrepreneur, you will share between 30%, between 10% to 30%. So depending on the extent of effort and expertise that you are lending into the business, you will share between 10% to 30%, whereas the capital owner will be sharing between 70% to 90%. And you will be running the business, and every year the partnership will determine what is the profit, and they will divide the profit between the mudarib, the entrepreneur, and the sahibul mal, the capital owner, on the basis of that agreed profit sharing arrangement, 10% to 30% for the entrepreneur, 70% to 90% to the capital owner. So in that respect, you do not need to have financing in Islamic business. Of course, the assumption is that you can find a capital owner that will be able to provide funding for the whole business. We are talking here about the main capital, about the initial capital. But in Islamic business, there is still some financing allowable for operation. For example, the business can still use leasing, which in Islam is called ijara, and leasing is essentially a form of borrowing, but you borrow to buy a machine or an equipment or a factory, and then you pay in installment every month in the form of rental. Or you may also still need the transaction financing. For example, you may be making some orders for a production, and you have to pay some deposit, and then you will pay the rest when the production is completed. So there is many form of financing by Asalam and so on. So in essence, the Islamic finance is different from the conventional finance because we do not exploit other people's capital to make profit. Any questions or comment on that?
No, Prof.
Right, good. Okay, now let's continue. We want to look at financial leverage. We want to discuss the significance of financial leverage, and we will describe the concept of EBIT. EBIT is profit before interest and tax, earning before interest and tax, and EPS analysis. EPS is the earning per share or profit per share, and we will look at the three types of leverage. We discussed just now financial leverage is also referred to as trading on equity or simply leverage. Any company or firm require financial capital to operate its business, and most of companies increase their capital by disposing their common share and giving out debt security in stock market. It is also important to note that amounts of equity and debt make up a business capital structure. So the capital of a business are normally comprised of both the equity and finance, or equity and borrowing. And it is important to note that the amount of equity and debt is associated with many risks and return implications. We discussed that, more finance promise higher return because the cost of borrowing is cheap, but expose the company with higher risk. The risk of if the business is slowing down, then we will have that situation just now, like driving a car, and suddenly you have to brake and reduce the speed from 100 to 20. And if you do not do anything, if you do not engage your clutch, then the car will jerk and just stop. And when the car stop, it's like a business that suddenly dead. Therefore, firms should use prudent strategy to establish its target capital structure. The capital structure is the strategy or process where firms or company use its fund to finance its operation and growth. A company capital structure employs financial leverage to finance its operation to ensure its growth and receive huge return. Financial leverage refer to a strategy employed by firm and companies to increase the return, cash flow, as well as asset. This strategy can be magnify asset because when you borrow, you have more capacity to buy asset, and it is also referred to as the investment strategy that a company or business use, especially financial instrument or borrowed capital to raise the level of expected return from the investment. Right. How do we measure financial leverage? Financial leverage is ascertained as a ratio of the amount of debt to the amount of asset. So the more debt you have in relations to assets, the higher will be your leverage or gearing. So it is debt to equity ratio, or total debt divided by total equity. It's illustrate the percentage of debt to the firm equity. The manager, the stakeholder, and lender will use it to understand a company capital structure risk level. And we discussed earlier that the higher the debt, the higher the risk, but also the higher the potential profit. It reveals the likelihood of a company to borrow funds to finance its operation. Therefore, financial leverage is worked out by divisions of the total amount of debt by total equity. So this is the formula. We have touched this somehow. In the formula, total debt comprised of long-term and short-term debt. Yeah? This is um, um, the short-term, the non-current liability and current liability both. The sensitivity in the fluctuations of a company's total profitability to the operating income volatility that is caused by change in capital structure is measured by a ratio known as the degree of financial leverage, DFL. So we use DFL, degree of financial leverage, as a way to measure the fluctuation, sensitivity, the sensitivity of the fluctuations of profit. What it means is that uh, when you have higher financial leverage, your potential of making profit is higher if your volume of sale goes up. So when you use leverage, you have higher borrowing, your degree of financial leverage will be high, and as you increase your revenue or sale, your potential of making profit become higher. But if suddenly the volume of business come down, sales drop, for example, during the COVID, or your business is being boycotted, and so a drop in revenue or sale will cause a bigger drop in profit if you have high borrowing or leverage. So it is worked out by the divisions of the percentage change in net income by percentage change in profit before interest and tax, or EBIT, earning before interest and tax. So this is the degree of financial leverage. There's several way of calculating degrees of financial leverage. This is one way. We take the percentage change in net income. Net income is actually operating profit, divide by percentage change in EBIT, or earning before interest and tax. EBIT is profit before interest and tax. So this is another way of calculating degree of financial leverage. Earning before interest and tax divide by earning before interest and tax minus interest. If we use our normal term, so we say that the degree of financial leverage is equals to profit before interest and tax divided by profit before tax. So our income statement is revenue less cost of sale equal gross profit or profit margin. Less operating overheads, and this is includes wages and salaries, rental, utilities. Utilities are all the electricity, water, uh, communication, and then office expense, depreciation. Then we have um, operating profit. Then we less interest, that equals to profit before tax. Okay, operating profit here is also called the profit before interest and tax. So let's put some figure so we can actually calculate. Hmm, Buat yang mati tu. Buat yang agree tu. Hmm. Okay, so here our revenue is 8.5 million. Cost of sale is 4.8 million. So the gross profit or profit margin is 3.7 million. And the operating overhead is 3 million. So the operating profit is 700,000 and interest is 300,000. So the profit before tax is 400. So if we calculate our degree of financial leverage, degree of financial leverage is operating profit or profit before interest and tax divide by profit before tax. So what is the difference between these two figure is the interest, yeah, interest. So this is 700 divided by 400. So we get 1.75. 1.75. Yeah? What does 1.75 mean? It means that first we say that the degree of financial leverage is rather high. Rather high because it is higher than one. Higher than one. If it is higher than one, then we say it's high. If it is lower than one, we say it is low. And it means if um, operating profit increase, or basically it means if revenue increase, then the gross profit increase, operating profit and operating profit increase, then the increase in profit before tax will be 1.75 times higher. It means that if the uh, degree of financial leverage is high, increase in the business turnover or sale, or increase in business volume will help increase the profit tremendously. But the same rate, if revenue drop, then gross profit drop, then operating profit will also drop, and the drop in the profit before tax will be higher, also by 1.75 times. Okay, so is that clear? Any question here?
No, Prof. Good.
Right, right. Okay, so we'll go back now. So we say that financial leverage can be actually a double-edged weapon. It can help us. It can also kill us. The formula shows that the percentage change in income involve the earning per share and the operating profit. A high degree of financial leverage illustrates that small change in leverage can greatly impact the firm's profitability. On the other hand, a low degree of financial leverage is an indication that the firm has a lower financial risk. Okay, so the effect of leverage on EPS. We now look at the effect on EPS. Why is EPS important? Because EPS is earning per share or profit per share. EPS will actually determine the share price. EPS is the abbreviation for earning per share, and financial leverage rises the volatility of a firm's earning per share, and the financial leverage magnifies shareholders' earning or earning per share, and it is also used to ascertain the sensitivity of the firm's earning per share. This is done when they are earning before interest and tax. If a company has a high degree of financial leverage, it has a high interest payment, and this will reduce the earning per share. It is also important to note that earning per share determine the company's profitability. If we go to our illustration just now, um, okay, so actually we can extend here profit before tax, then less taxation at 24%. I'm always using 24% because this is the tax rate for company in Malaysia. So $96 is profit after tax. 304. And then if we know what is the number of shares outstanding, let's say number of shares is million, and the earning per share is earning per share is actually profit after tax divided by number of shares. So this is 0.0506. Or it is normally expressed also in cent. In cent is 5.06 cent. So we can also calculate the share price if we have the price. So we are using the price earning ratio of 8 times, assuming that this is a non-listed company. If it is a listed company, then we will take the average price earning ratio in the market. But for non-listed company, normally we will use the price earning ratio of 8. So the share price should be about 40, 4048. or 40 cent, yeah, about 40 cent. Right. Um, so what we are saying is that if the um, financial leverage is high, means we have high interest here. Then if revenue goes up, then the profit will also go up, and the earning per share will also go up, and the share price will also go up. But if revenue come down, then the uh, um, profit before operating profit will come down. Interest is the same, so profit before tax will come down much higher or much bigger, and profit after tax will also be as contracting bigger, and the earning per share will become much lower, and the share price will also become much lower. So it is a systematic effect on the performance of the company. Question? Right. Let's get back to the so leverage will also have a severe impact on the earning per share and the share price. That's the main thing. Leverage will determine the strategy that put in place to finance a business operation to yield a huge return. So if we have a business that have a very stable revenue, then we can use a high uh, debt or borrowing, and that will result in a high leverage. But as long as revenue is stable, then we have no risk. But if revenue is not stable, as in the case of a retail business, then we need to be very careful in the decision on leverage, because if we borrow too much to finance our business, and suddenly our business come down because of some form of crisis in the market, then we will have the big impact. It will have a big impact on our business performance. Um, the increase, this increase the risk, risk level. So financial leverage will increase our business risk, and we need to plan to make sure that our business risk is manageable. An increase in interest payment will lead to reduction in the firm earning per share. Therefore, earning per share do not always increase with an increase in financial leverage. This occurs when the firm cannot earn more profit than the value of debt. Okay. Earning per share is worked out by the division of the company total earning by the total number of outstanding shares. And the figure determined from the formula may not sometimes make sense. Nevertheless, the figure needs to be analyzed against other firms in the same industry to be more valuable. The earning per share is used together with the firm's share price to ascertain if it is cheaper or expensive. Um, it is always cheap when the price earning ratio is low, and expensive when the price earning ratio is high. So The two methods of calculating the earning per share here basically is net income minus preferred dividend. What is preferred dividend is the dividend to the preference shareholders, and divide by the weighted average share outstanding, or the number of shares basically. Or another formula is earning per share is equal to net income minus preferred dividend divided by the number of shares at the end of the period. Well, normally number of shares does not change quite frequently unless the company increase their their capital contribution. So the EPS figure is significant because analysts and investors use it to determine the performance of a company. It can also be used to predict the future earning. And last, it can be used to ascertain the value of the company share. The higher the earning per share, the higher the profitability, and the more profit is available to be shared among the shareholders. Ini bukan gula-gula ni, whitening. Dia buat hati ni, limau. Tak apa-apa. Kalau limau. EBIT EPS analysis. EBIT, as we discussed earlier, is the profit before interest and tax. EPS is the earning per share or profit per share. EBIT EPS analysis ascertain the financial leverage impact or impact of borrowing on the EPS with different level of EBIT. Capital structure is critical in EBIT EPS analysis. This is because it shows the relationship between debt and equity. EBIT EPS analysis compare different financial plans and determine the best way to leverage the earning per share. Investors and analysts use this analysis to evaluate the various methods of financial planning. The method of financial planning with higher EPS and the most profitable EBIT is most preferable. EBIT is the earning of a firm before interest and tax. While EPS is the earning per share. Earning per share show the company's profitability and includes the impact of interest and tax. So EPS is very significant to investor. EBIT EPS analysis is significant in a company because of various reasons. Number one, a company management use EBIT EPS analysis to determine the right scale of debt and equity financing in a firm's capital structure. A successful company need to make a good decision and plan carefully regarding the trade-off between equity or capital and borrowing debt to finance its operation. Finance manager will use EBIT EPS analysis to make important decisions regarding the capital structure. It is important use it is also important to ascertain the most desirable profit level of EBIT, and it is also used to ascertain the most desirable profit level. Using the approach, analysis can be made to determine the impact of the changes in the capital structure. So essentially, as we discussed, uh, we can come up with a financial projection for next year and then vary the borrowing. And when we vary the borrowing, we will vary the interest expense, and that will change the gearing or the leverage and the profit after tax figure. Analysis studies the composition of financial leverage. Analysis will determine the impact of financial leverage on the EPS behavior with regard to different alternatives for financing company's operation. It is important to note that a company is aimed to maximize EPS in every financial plan. So it is used to determine the choice of the combination of the various sources. Of course, there is a limitation on the EBIT EPS analysis. Financial manager may forget to control costs and limit risks associated with venturing into a given project. This is because EBIT EPS approach is almost at maximizing the EPS. This analysis approach is not the best for making critical decisions regarding capital restructuring because it is not a diversified method. It does not put into consideration some other factors that may affect the company's profitability, like the external factor, yeah, the government intervention and so on. Okay, indifferent point. Indifferent point is also known as the equivalent point. This refers to the level of EBIT or profit before interest and tax, where EPS remain constant regardless of the different alternative of debt and equity scale. Here, the rate of return on capital used is equivalent to the cost of debt. This level is also referred to as the break-even level of EBIT. So essentially what we want to do is to find a break-even point level where at that point the form of financing doesn't make any difference. Sometimes a firm may like to make a choice between two levels of debt. Then the indifferent point will be as follows. So this is 1 minus T. T is the tax. EBIT is the profit before interest and tax minus interest. And here is for N is N is here. And here is 1 minus T, the same formula, but for another year, interest 2. If the firm may compare between an all equity and preference shares plan, then the different point formula will be as follow. So this is if we use the preference share, and in the preference shares we need to pay preference share dividend. So PDIV is the preference share dividend. The formula can be simplified into a following formula. Here is uh, profit before interest and tax minus interest multiplied by 1 minus t. This is taking into account the tax rate, because why we take into account interest is because interest, sorry, why we take into account tax is because interest is tax deductible. And so we need to take into account interest because interest is being subsidized by the government in the form of tax deductibility. So here is some interest or profit before interest and tax minus interest for B multiplied by 1 minus T and minus preference shares dividend. Okay, this is a graph that can be plotted by considering the two alternative finance capital structure using debt financing, using capital financing. Um, Notice here, when you use debt financing, the potential profit before interest and tax is higher compared if you use all equity or capital. So here is the benefit from debt financing. And this is the benefit from equity financing. And here at the break-even point is the indifferent point. Essentially, what we are saying here, up to a certain level, equity financing is better. But beyond that, debt financing is better. And what is that level? We can calculate that, but it is actually not a hard fact, because that can vary depending on situation. But we can safely say that as the volume of business goes up, then the debt financing will be will give a better impact. Yeah? Right. The graph show that the EBIT EPS analysis, where EBIT intersect the indifferent point, this is the intersection point, both equity financing and debt financing product equals. So at this point, they are the same. Nevertheless, when profit before tax is of lesser value, then equity financing will always be uh, giving higher EPS compared to debt financing. The value of EBIT, or profit before interest and tax, on the right side of the indifferent point, and the debt financing give higher earning per share than equity financing because there is a higher degree of financial leverage. Right. This is used to a degree of financial leverage is used to determine the EPS percentage change for the earning before interest and tax unit change, that is operating income, and it can also be described as a financial ratio that ascertain the sensitivity in fluctuation in a firm total profitability to operating income validity as a result of the fluctuation um, in the capital structure. It is consisting of the formula that is used to measure the financial leverage learned earlier. And it is worked out by the divisions of the EPS percentage change by the EBIT. So essentially, degree of financial leverage we calculated earlier as percentage change in EBIT divided by percentage change in EPS. Here we are relating EBIT with EPS. Before, we are comparing EBIT with profit before tax. So the ratio show that the higher the DFL, the higher will be the volatility in earnings or earning per share. So financial leverage can be described and defined as the use of debt or borrowing to fund purchase of asset, expecting that capital or income gain from the purchase of asset will be more than the cost of borrowing. So financial leverage amplify the owner's capital investment into huge return. Financial leverage maximize the use of fixed income security and preference share of preferred stock in the capital structure of the firm. Financial leverage increase the value of purchased asset by the use of debt, and the assets are made to earn more than the cost of the debt used to fund them. Therefore, financial leverage increase the company's profit. There are three classes of leverage, and these classes include financial leverage, operating leverage, and the combined leverage. Let's discuss the class, three classes of leverage, three types of leverage. Financial leverage is financial leverage involved with profit magnification, and it is aimed to maximize asset purchase by borrowed capital to make huge return. And we can visualize this normally in the high in capital investment project. For example, if you are involved in a solar farm, you want to create a solar farm that will supply electricity to a particular project or particular community. And the idea is the bigger the farm, of course, the bigger the output. So if you can sign a contract, for example, with TNB or with a particular company or community, that they will buy all your electricity power generated, then you can use the maximum borrowing. Why? Because as we mentioned earlier, that normally the return on investment is much higher than the cost of borrowing. So the more borrowing you have, the more profit that you will make, as the margin or the difference between the borrowing costs and the potential revenue. So that's the basic financial leverage. Borrowing, maximize borrowing to maximize profit. That's the first class. Yeah? The second class is operating leverage, and this type of leverage determines the extent to which a company can raise its operating income while increasing its revenue. And it is important to note that company that can make sales with a low variable cost and a high gross margin is said to have high operating leverage. Um, if you remember, I think we have discussed this. Operating leverage is another measure. Uh, we have the degree of operating leverage, or DOL. This is also called the just operating leverage, and essentially operating leverage is the difference between gross profit is also called the profit margin, let me, I don't want to confuse you, so it is like that, and divide that by the um, uh, uh, operating profit. Essentially, the difference between uh, gross profit and operating profit is the operating overhead. Yeah, yeah. So this is gross profit. This is operating profit, and the difference is operating overhead. So it is the operating overhead that determine this ratio. We say operating profit here is also called EBIT, meaning before interest and tax. So if we take our figure just on top here, it is 3007 divided by 700. So here our operating leverage is very high. 3007 divided by 700. It is 5.2857. What does that mean? It means that if revenue increase, then operating profit will increase by 5.2857 times. So it means that that business volume is very important, very crucial in this kind of business. The same thing here. If revenue drop, then 1% drop in revenue will drop operating profit by 5.2857 times. So in business like this, revenue is important, and you need to make sure that your revenue keep on increasing instead of dropping. So if you are in this kind of business where your revenue is quickly rising every day, every month, so you can have a business with high operating overhead. When you have high operating overhead, then your operating leverage will be high. And with that, you will have a high potential of maximizing profit. Any question or comment? Okay, back to the notes. So this is the degree of operating leverage, percentage change in EBIT divided by percentage change in sales. Actually, what we have done was using the second one, quantity multiplied by contribution margin, which is the gross profit, divided by quantity multiplied by contribution margin less fixed operating costs. So that gives us the degree of operating leverage. Now, operating leverage determines that a company use to fund its operation, and low operating leverage is an implication that the company is struggling with high costs that are indirectly proportional to the sale. So it is a measure of how sensitive the net operating income is to the percentage change in sale. With high leverage, small percentage increase in sale produce much higher percentage increase in profit. That's why this is the formula that we are using. Degree of operating leverage, contribution margin divided by net operating income. Okay, that's the number 2, leverage. Number 3, combined leverage. Combined leverage is the leverage that indicate the benefit and risk which are in a fixed quantity, and it shows high profit that are due to fixed costs in the company, and it is used to ascertain the appropriate financial and operating leverage that is applied in any company. The degree of combined leverage is calculated by dividing contribution or the gross profit by the earning before tax or profit before tax. So we can calculate here the combined leverage. This is gross profit divided by profit before tax. And the profit before tax is 400. So this is 9.25. So essentially what it means is, it means if revenue goes up, then profit before tax will go up by 9.25 times. So this is the extent of effect of both. This is the both effect. It take into account both the operating overheads and the interest effect on profitability. Right. Significance of financial leverage. Financial leverage is useful in a company for various reasons. It provides firms with the benefit uh, um, the firm can use financing resources to attain its targeted earning. The firms use it in making the investment as it helps them to set the threshold for the expanding operation, and the firm also use it to make financing and investment decisions. So in summary, financial leverage is also referred to as the trading or equity or simply leverage. Financial leverage refers to strategy employed by firm to and companies to increase return, cash flow, and asset. Financial leverage worked out as the ratio of total debt to total asset. High degree of financial leverage illustrate that small change in leverage can greatly impact the firm's profitability. And financial leverage magnify shareholders' earning and used to ascertain the sensitivity of a firm's earning per share. Leverage determine the strategies put in place to finance a business operation to yield huge return. Earning per share refer to the company's net profit divided by the number of shares outstanding. EBIT EPS analysis ascertain the financial leverage effect on earning per share. Investors and analysts use EBIT EPS analysis to evaluate various methods of financial planning. Company management use EBIT EPS analysis to determine the right mix of debt and equity financing in a firm capital structure. The indifferent point is also known as the equivalent point, and it refers to the level of earning before interest and tax or profit before interest and tax, where EPS remain constant regardless of the different alternative of debt equity mix. And financial leverage amplifies the owner's capital investment into huge return. Right. So the topic highlighted the importance of borrowing in business. Except that now, when we relate this with Islamic finance, for example, when we are not or we when we do not use any when we do not use any borrowing, then when we don't use any borrowing, how can we take into account financial leverage? Yeah. So if in Islamic finance we say just now that we do not use leverage because everything is using equity financing, but actually we will still be able to use indirect leverage. Yeah. What is the indirect leverage? For example, so Islamic finance. In Islamic finance, everything is equity financing, no borrowing. But indirect indirect leverage is still available. What is this? This is in the form of leasing, or in Islam it is called ijara. Essentially involve long-term rental of equipment or buildings or plant. So we can still use leasing, and when we use leasing, we do not have to buy. So we save ourselves from buying, and we are still able to use the facility in the form of rental payment, and that is an indirect financing that involve less risk, yeah? Because in leasing, though we sign a long-term rental, but the equipment is not ours, and we do not borrow. We do not borrow from others, and there could be some form of what is called as the transaction financing. This is the basically in terms of what is called as by salam, where we pay in advance to order something. So instead of producing it ourselves, we order from the big manufacturer to produce for us on contract, and that's is even bigger form uh, of leveraging, because in the normal operation you need to invest on all the manufacturing facility, and you have to take the risk of managing the operation. But in the transaction financing, you just order from the manufacturer, and they will produce for you, and you will just market, for example. That's the future business. And so in that perspective, Islamic finance is trying to reduce the risk on financing, and hence reducing the overall risk in business. Any question or comment? Right. Let's take a 5-minute break before we move to another topic.
Prof,
Yes.
can I ask you on the assignment group?
Yes. Yes.
Okay, I see in the group there's people with the team members already, but I haven't got my team members, huh? Is there any lead that coming from you, or we just pick our own team member and just post in the group?
You pick your own team,
Oh, I
so
see.
you can offer yourself to become member of any of the team.
Oh, because I don't know any other members that taking, because we have from different classes. So I'm not sure whether people in this group have still available spot for me to join.
Offer yourself.
Yeah, I'm offering myself in the group, but no one has responded yet. So just maybe take these chances to ask them lah. If
Okay.
anyone still have spot, I would like to join lah.
Otherwise, you form a new group.
Okay, I can try that lah.
Uh,
Or maybe how many person student right now in your class, so that we know if one group is 4%, maybe you can do division and see how many left that still have no group lah.
Okay, there is supposed to be about 30% in the group, in the
30%.
class. Yeah, 30%.
So main group 7 is the last lah. I see
I
there's a
guess
group
so.
6, so 4 times 6 is 24 people already. So last
Uh,
group lah. So I just create the last group lah, group 7.
yes, that's
So for
good.
the rest
That's
who still have not yet any group, just please join me later. I will create the
yes,
group and the link. Thank you.
yes, yeah, good spirit. Yes.
Okay, thank you. Thank you.
There's still somebody who cannot enter the class. Are you in here, Gauri? All right. Let's get back to class. We now want to relate this with capital structure theories. Yeah. We know that leverage will determine the capital structure. Essentially, the higher the borrowing, the higher the leverage. And the higher the leverage, then the capital structure is more debt based structure. So we want to look at the term capital structure theories, explain the concept of net income approach, concept of net operating income, concept of traditional approach, and M&M approach, or Modigliani and Miller approach. Okay. Capital structure illustrate companies listed in various stock exchange use different structure to fund their project and investment. Capital structure involve combinations of all long-term finance source such as reserve and surplus. Reserve and surplus are the accumulated profit or profit of the company that are not paid in the form of dividend but reinvested. Debentures loan issued by company and conventional bank loan, equity shares, capital, and preference shares capital. These sources of finance are divided into two, the external and the internal. There are various theories that are used to explain the determinations of capital structure, and capital structure is used as financial leverage, which is the degree to which a company uses debt or borrowed money. And it is important in a business as it is making a vital decision. And it is important to note that capital structure may be irrelevant regarding some particular restrictive assumption. The capital structure theory is a standard and logical approach to finance a firm operation by combining liabilities and equities. So the various capital structure theory justify the significance of capital structure for a business or a company. M&M capital structure, or the Modigliani and Miller capital structure irrelevance theory, is regarded as to be the basis for the modern capital structure theories. There have been conflicting opinions that argue whether or not this decision regarding capital structure impact a company value. Nevertheless, capital structure theory aim to explain the relationship between companies' market value and decision regarding the company's capital structure. There are various capital structure theory, including the Modigliani and Miller approach, M&M approach, the net income approach, NI approach, the net operating income approach, or net NOI approach, and the traditional approach. Okay, so we'll start with the net income approach. This is also referred to the NI technique or approach, or the fixed KE theory. The approach was developed by Duran, who argued that a change in capital cost could be caused by financial leverage. So he penetrated that a rise in the debt in the capital structure ratio would lead to a reduction in the weighted average cost of capital. So the idea is, if you increase debt or borrowing, then your weighted average cost of capital will come down. Why? Because borrowing is the cheapest form of capital. The net income approach propagates that a company value is increased by reducing the total capital cost, which is the average, the weighted average cost of capital, by having a huge proportion of debt. And this is so because debt is regarded as the cheapest source of finance. Furthermore, as you have seen earlier, debt is partly sponsored by the income tax, because when you use debt, the interest expense is tax deductible. Compare if you use preference share, for example, the dividend that you pay to the preference shareholders are not tax deductible. So there is a tax benefit. Tax is regarded to be a interest is regarded as deductible expense for income tax purposes. There are lower rates of interest than dividend because of the risk element. The weighted average cost of capital is the average of the cost of debt and equity, and it worked out by the formula here. Basically, you take the weighted average, the return rate on equity plus the return rate on debt. So it is important to note that the income approach works under the following assumption. First, the personal or corporate tax are not considered, or others are considered absent. And there is no shortage of finance. There is a perfect capital market, and that use does not affect the perceptions of risk of investor, and the equity cost is greater than the debt cost. So there are no transaction and flotation cost. Generally, the approach highlights that financial leverage has an impact on the capital cost and influence the company's value. And the net income approach can be presented graphically. This is as proportions of debt, KD, in the capital structure increase, the weighted average cost of capital will be reduced. So essentially, the cost of capital will reduce as we increase debt. The graph shows that the debt cost KD, remain the same together with the equity cost KE. So KD and KE is a horizontal line. As the proportions of debt to equity is raised. So as a result, the debt costs and equity costs curve remain parallel to the x-axis. However, the cost of a capital KO decrease as the proportions of debt to equity increases. But it does not touch the cost of debt curve because a company cannot exist under only debt. So for ideal case, the company capital structure should be one where the KO is closest to the KD. So essentially, KE is equity, KD is debt, and because it is the weighted average, it will keep reducing, and it will be near KD but not touching KD. At this point, the proportion of the equity cost is minimal and the cost of capital is at its lowest. And the company's market value and share are at their highest. This clearly shows that the income approach main intention is to illustrate that raise in debt proportion in a companies would lead to raise in the proportions of source of finance that are cheap. Net income approach formula is given by V plus S is equal to D, where D represent the market value of debt, S represent equity, and V is the total market value. So this can be reflected in the chart where the value of the firm can be increased by decreasing the overall cost of capital or weighted average cost of capital through higher debt proportion. And the assumption, of course, is that the confident market of the investor will not be affected when a company increases their debt. And the source of finance, like the preference share and retained earnings, is not available. And uniform dividend payout ratio is 1. Flotation cost is 0. There is no cost of listing. Transaction cost is 0. And CDT is 0%. This is the tax rate. Perfect capital market and infinite source of capital. So here, profit before interest and tax, less interest cost, which is the cost on debt, equals to earning after tax. As tax exception, there's no tax. Shareholders' earning is earning after tax is equal to earnings after tax, and the market value of equity is shareholders' earning divided by cost of equity. The market value of debt, F, and the total market value of the firm is market value of debt plus market value of equity. And the overall cost of capital in percentage is profit before interest and tax divided by the total market value. Right. Essentially, the net income approach, a basic principle is we should maximize borrowing to reduce the weighted average cost of capital and to increase the market value of the company. Any question there? Right. Next is the second method is the net operating income approach, NOI approach. The approach propagates that a company's value is greatly dependent on associated business risks and operating income. The theory is developed by David Duran, who argued that changes in that component could not affect company's value. Therefore, a company's market value will remain constant even with the change in that proportion. So in this case, the higher return rate in the companies offset the cheaper debt. And this makes the company's market value and the weighted average capital cost to remain the same regardless of any financial leverage. So the company market value will rely on weighted average cost of capital and the earning before interest and tax. And this approach is possible with regard to the various assumptions made. And this assumption is that the debt cost, KD, is the same regardless of any financial leverage level. And there is a constant capitalization of debt. And equity cost is greater than the debt cost. Of course, equity cost is greater than the debt cost because the expectation of the shareholder or the investors are higher than the borrowing costs or debt costs. And the payout ratio of dividend is 1. That means all the profit is being paid by as dividend. And the company value with regards to the weighted average cost of capital and earning before income and tax. So the company does not have retained earning. The weighted average cost of capital remains the same even with the increased debt and equity and does not affect the capital structure. So the formula for working the net operating income approach is value is equals to profit before interest and tax divided by the weighted average cost of capital. So here, EBIT or earning before interest and tax and WACC are regarded to not relate to the capital structure. And the shareholders' market value, E, is worked out by subtracting that market value from the company market value. So Uh, V is the market value of the company. D is the debt value. So the company, the shareholders' market value is E equals to V minus D. The required return for a company investment is worked out as AE, which is cost of equity, multiplied by earning before interest and tax minus 1 divided by equity. And that cost is assumed to be constant. There are various graphs that can be used to represent this net operating income. This is the financial leverage debt to equity ratio. This is debt, this is equity, and this is the weighted average cost. And here is the financial leverage debt equity, where the equity cost is curving, and the net income approach of capital structure, so the value of the firm as the difference between the value of a company, which is earning before interest and tax divided by weighted average cost of capital minus the debt value. Okay. In the graph above, replacing equity with cheap debt does not lead to weighted average cost of capital reduction. However, it will result in the rise in risk level as well as the financial leverage. And this will result in an increase in the capital cost. So investors will demand high return to compensate for the high risk associated with the business that they venture. And therefore, it is important to note that financial leverage that are high offset the equity cost increase. So in this case, the weighted average cost of capital remain the same. Below is the chart that gives the summary of the net operating approach. So net operating income approach suggests that the value of the firm is dependent on the operating income and the associated business risk. Operating income is net profit after tax. And changes in the leverage debt, changes in the leverage or debt will fail to affect the value of the firm. The assumption is overall capitalization rate remained constant irrespective of that, and the value of equity is the difference between total value less value of debt. So weighted average cost of capital remain constant. So the net operating income and the net income approach have various different in regards with the role of capital structure assumption and the degree of leverage and cost of capital. Net operating income has no capital structure relevance in the company value, while the net income has capital structure relevance to the company value. The assumption made by the net income approach include debt cost is greater than equity cost, no taxes, investors' perception is not changed by that, and the assumption made by net operating income approach are that the equity value is residual. The capital cost is always the same, and the increase of debt increases shareholders' expectation. The net operating income assumes that the extent of leverage is not related to capital cost, while the net income approach assumes that the extent of leverage changes the weighted average cost of capital. Here is the summary of the difference between the net income and the net operating approach. Under the net income approach, there is relevance of capital structure in the value of the firm. Under net operating income, there's no relevance of capital structure. The degree of capital of leverage and capital and cost of degree of leverage and cost of capital. The net income approach assumes that changes in the degree of leverage will alter the weighted average cost of capital. Under the net operating income, the degree of leverage is irrelevant to the cost of capital. And the assumption, no tax under the net income, cost of debt is less than cost of equity, and that does not change the perception of investor. Under the net operating income, the assumption is cost of capital is always constant, value of equity is residual, and increase in debt increase the expectation of the shareholder. Right. Now we will look at the traditional theories. The traditional theory propagate that optimal capital structure will exist if there is a minimization of the weighted average cost of capital and the maximizations of the asset market value. The approach was developed on the basis of classical economics, and in this approach, a company's market value is affected by the financing mix. So the equity cost is greater than the marginal debt cost. And the approach encouraged companies to adopt a financing mix where the company value is maximum. And it is important to note that for the traditional theory to be successful, then the assumption is all companies aim at making profit. That company will maximize profit by using marginal analysis, and managers and companies are rational. Marginal analysis means they are looking at the short term in future. Right. Then there is information symmetric. That means informations are available to everyone in the company, whereby employees and employers have access to information that is aimed at profit maximization. And company will behave as homogeneous unit whose owner are focused on maximizing profit. And interest rate of debt will always be the same for a given period of time. And the prospect return rate by the equity shareholder will be the same or increase gradually. Therefore, it is essential to note that the approach is aimed at maximizing profit, and this is the main theory of a company with regards to this approach. So, the theory of profit maximization assumes that all companies are after making profit, and this helps to maximize the fund of the owners of the company. Therefore, the company will seek to minimize the cost of production and to maximize profit. This is illustrated in the graph below. Basically, profit maximization is when marginal cost equals to marginal revenue. That means the increase in revenue equals the increase in cost. So below market maximization is uh, um, situation where profit increasing. This is where marginal revenue is higher than marginal cost. And after that equilibrium point, profit decreasing, marginal revenue is higher than the marginal cost. The traditional approach is faced with various criticism because of the various weaknesses and limitations associated with the approach. The criticism include market has imperfect information. Different people have different information regarding the market. So some of the different information different people have included information regarding prices, competition, and costs. And companies are aimed at achieving behavioral economics and not only profit maximization. Companies are also uh, having other objectives such as market share maximization, sales maximization, and social responsibility. Companies are not a homogeneous unit, and different stakeholders of the company have different objectives. So, other than profit maximization, uh, there are other theories a company apply is corporate social responsibility that portrayed the company's different objective of giving back to the community by allocating some of the profit to provide certain services to the community. Growth maximization, company aims to increase its size by undertaking a risky expansion. Sales maximization. In this theory, the company opts to reduce its price in pursuit of increasing its sales. So company opts to maximize sales for different reasons, such as gaining success in broader dimension and profit-wise, increasing the market share, and increasing managerial salary. maximizations on managerial utilities. This theory hold that there are many things that that can be used to determine the manager's utilities. This include developing better relationship with employees to increase their self-esteem. Manager can also have fringe benefit to getting a lot of managerial utilities. Okay, finally, the Modigliani and Miller approach, MM approach. This is developed in 1950s by these two prominent finance experts, Prof. Modigliani and Miller. And the approach perpetrates that company value is irrelevant to the structure of capital. Therefore, it is slightly similar to the net income approach. It argues that low debt and high leverage have no impact on the company values. Low debt and high leverage have no impact on company values. Nevertheless, the approach holds that the company's value is affected by the earning before interest and tax, or operating income or operating profit. However, for the approach to be viable, the following assumption needs to be held. One is it does not consider corporate tax. There is no corporate tax. That means it assumes that there is no tax. There are no transaction costs in the market during the selling and buying of security. So there are similar costs of borrowing, capital and finance. Cost of borrowing here are related to the formality and the legal costs and so on. The information in the market is metrical. Everybody has the same information. And it does not consider flotation costs, the listing costs. So the approach has two proportions that do not have taxes. In proportion one, the assumption does not have taxes, and the company value is not affected by the structure of the firm. So the company's financial leverage does not increase its market value. It also holds that the equity shareholders and the debt shareholders have equal priority. In the proportion 2, this assumption holds that company financial leverage is directly proportional to the equity cost. Therefore, an increase in the components of debt will increase the risk to a company, and this makes the return of the company owner to be high. So, what is the determinants of capital structure in practice? Capital structure is the method a company chooses to fund its asset and investment by combining internal fund, which is equity, debt. Internal fund is the shareholder accumulated profit, debt or borrowing, and equity, the shareholders' capital. There are various determinants of the structure of capital, and this include capital cost. This is the lowest amount of return of capital invested in a particular project by a company. The return is greatly dependent on the risk taken by the investor. The cash flow, refer to the amounts of cash flowing in and out of a company in a particular period of time. Flexibility of the company refer to the ability of a company to adopt its structure of capital amid the changing season and the nature and size of the company. Large company can use and employ more debt and equity, and a small company with regards to earning can they can make the stability of the company with regards to the number of sale company makes in the period. So in summary, the structure of capital involves combinations of all long-term finance sources such as reserve and surplus are the accumulated profit, debentures, loan, equity share capital, the shareholders' investment, and the preference shareholder capital. The net income approach propagate a company's value increase by reducing the total capital cost, which is the weighted average cost of capital by having huge debt. The net operating income approach propagate that company's value is greatly dependent on the association between risk and operating income. So the theory was also developed by David Duran, who argued that changes in that component could not affect the company value. The traditional approach propagate that annual capital structure will exist if there is a maximization of weighted average cost of capital and the maximizations of asset market value. The Modigliani and Miller approach perpetrates that company's value is relevant to the structure of capital and is slightly similar to the net operating income approach. Right. This is the theory. So all you need to remember is the the four theory, main theory. The four main theory has a different perspective. The net income approach, the net operating income approach, the traditional theory approach, and the Modigliani and Miller approach. Any questions or comment?
So far, no, Prof.
Right. So we have covered so far the overall discussion, capital budgeting, cost of capital, financial leverage, and capital structure theory. Essentially, the capital structure theory is relevant because of the basic tenet in conventional finance that borrowing is the best form of capital, and this is the principle of OPM. Yeah? OPM. Uh, so we say in conventional finance, OPM is the best form of capital. And OPM stand for other people's money. I mean, I do not know how this theory come about, but essentially that's the perception, attitude, and the culture of a person. Essentially, the perspective is if we can borrow to start a business, then that is much better than using your own capital. Of course, the premise is that if you borrow, you will reduce your risk because the money does not belong to you. Um, but the question is, even though the money does not belong to you, but the responsibility is still yours, in the sense that you are responsible to return back the money to the lender. Of course, the question is, what if the business went bad and you cannot return back the money to the lender? What will happen? It depends on the relationship between the lender and you. If the borrowers is the company, then you are not seen as the direct party to the borrowing. So the lender will have to claim back their loan to the company that was borrowing. But normally, in the case of a public company or private company, you as the person responsible will have to also become guarantor to the loan. So if you become guarantor to the loan, you become personally responsible to the loan. And if you become responsible personally, uh, is will that still make borrowing better than your own capital? That's question number one. Number two, of course, uh, uh, the cost of borrowing is always cheaper than the cost of equity. So we will discuss here the perspective of conventional finance. Borrowing is the best form of capital. That's the perspective. And when it is the company that borrow, as the owner of the company, you are not directly connected with the borrowing. So your ability is limited to the amount of capital that you have injected into the business. But if you are dragged to be the guarantor of the loan, then you are personally responsible, and your personal asset can be dragged into the financing. So that's the first point to say that conventional finance or borrowing may not always be the best, yeah, because you may personally be dragged. Next is some borrowing costs. Is always lower compared to the equity financing. This is because the expectation of the shareholder or investor are always higher than the borrowing cost. The lender, especially the bank, are having low cost of lending because of the fractional banking system, where they are allowed to lend more than 9 times their deposit with the central bank. So if you are a bank, you collected deposit from your depositor, your customer, 1 billion, you can the deposit back all this 1 billion with the central bank, and the central bank will give you the right to lend 9 times or more of the of the deposit that you make to them. And as a result, actually your borrowing cost as a bank is very low. Uh, Today, if you save your money in the bank may pay you 1 or 2% per annum. But you are paying 1 or 2% per annum, but you have the right to actually use the money of the investor in your bank by depositing that money with the central bank, and the central bank then give you the right to provide loan 9 times of that deposit. So you are now able to magnify your ability to lend. And because of that, actually the borrowing cost will be much lower than the expectation of the shareholder. And because of that, you see that the borrowing cost is relatively low or lower than the capital cost. Um, so so the bank is able to provide loan at a cheaper rate, and what will determine that rate is normally the risk profile of the investor. If your risk profile is low because you are you have a lot of financial backing or asset backing, then the bank will reduce their risk, and the bank will be able to offer you a much cheaper rate in terms of the loan. Okay, but um, so in reality, as a customer of bank, we are um, uh, at the mercy of the bank on this rate of borrowing. And as we discussed earlier in the operating leverage theory, the higher the borrowing, the higher the potential of making profit, but also the higher the risk. So if we expect that our business is going to go up, so we should borrow more. But we must make sure that the volume of business will not drop. So as the example I cited, if you now get a contract to provide energy to a particular industry in an area, and you are installing the solar panel, so the solar panel is your investment. Because you have a guaranteed market, so and the market is big, so you can use high financing, high borrowing. So you borrow a high, and when you borrow high, you will be able to supply higher amounts of electricity output to your customer, and you will increase your revenue. So when you increase your revenue, you will increase your profit. Right. The risk in borrowing will increase the risk in business. So that will increase the expectation of return by the shareholders. And this is what the Modigliani and Miller and as we discussed earlier, the Modigliani and Miller and the net income approach. The net operating income approach basically stated that the increase in debt will increase the business risk, and hence it is actually making the business making the prospect of the business less attractive. So um, high borrowing does not always promise high return on the shareholders. These are the important consideration that you need to take into account in the capital structure. Right. I will pass this to you now. Next week, I'm not sure what that is, but this is not relevant to us. Yeah? Okay, I don't know what that is, but can you open my file? Be careful, there may be virus. Right, next week we will discuss about mergers and acquisition. This is related to your assignment 2.